Hey, if you're trying to scale your real estate portfolio, you probably run into a massive roadblock. Traditional banks tell you that if you want the best rates, you're going to have to close in your personal name, forcing you to choose between funding your next deal or keeping your assets protected. Well, today we're going to be shattering this myth. In fact, I'm joined by Randy Zimnoch from Optimus Capital, and we're going to be breaking down how you can go out there as a real estate investor, if you're a flipper, if you're somebody that is a residential investor, and how you can acquire properties at conventional rates without having to go through all that process that a conventional lender is going to require you. And better yet, you can close in limited liability companies and other structures. So here's the deal. If you want to scale fast without blowing up your asset protection shield, then you're going to want to pay close attention to this episode with Randy because he's going to be breaking all of that down for you. All right, let's dive into it. All right, Randy. Hey, welcome to my YouTube channel. Now, here's what I want to start off with. You talk about the 4 stages of becoming fundable, right? But my audience's biggest fear is that lenders will force them to strip away their LLCs just to get a loan. So, if we can, because my channel is all about asset protection using entities for investing, could we just start right there talking about the framework of, that you walk through about becoming bankable and the guidelines and all of that? Would that work?
Yeah, that can work for us. And
All right.
hopefully it's what your audience wants to hear. Sometimes it's not always this, exactly that.
Yeah, well, we should. So what I find is this, right? That a lot of people they get hung up with the conventional financing that's out there, and that stops their ability to scale. And
Yeah,
you have those 4 stages in your framework, right? And you talk about bankable, talk about conforming guidelines. That Freddie Fannie stuff always has to be in an individual's name if it's residential real estate, which is a nightmare when it comes to asset protection because obviously I don't want to close in my own name if I don't have to. I want to close in a limited liability company. So when you
yeah.
transition to investable and then fundable, where these they can actually close 100% of these deals directly in an LLC. Is that correct?
That is correct.
Okay.
Yes. Now, where we might run into challenges is if someone asks me about a land trust or like a private trust. I just had a borrower ask me, and we unfortunately ran into challenges. It's very, very difficult to find any capital partner that's comfortable. Not that they don't exist, just know that access to those will be very, very limited. And usually your LTV will be reduced quite a bit if you find one that will lend to a land trust.
Okay, so when we're talking about lending, then let's break that down. So what you're saying is that if I have an entity, Optimus will actually loan to that entity. I can close in a deal in the name of an LLC, but not necessarily in a land trust. Is that what I'm hearing?
That's right. Yes. Yeah. So I guess let me also explain that we do direct lending. That's one, mainly for flip loans in about 10 states and growing. Any DSCR loans, we go to other capital partners, and those could be, private lenders. And I'm talking about private institutional money, right? Not like a doctor that you know down the street, right? Uh, those could be life insurance companies. Those could be, companies that just deal on the wholesale side. So a lot of those guidelines basically will decline land trusts, right? Many will allow personal name for a specifically DSCR loans. Some will require, an LLC. Most institutional hard money, including in-house, in most cases, will actually require an LLC or a corporation of some sort for you to close. Now, the interesting caveat that I just actually ran for somebody, they had an option to do a DSCR loan in an LLC, but the title in an LLC, but the loan, what they had an option. They can do the loan in the personal name, right? Or they can do the loan in the LLC. In both cases, they would have to personally guarantee it with this capital partner, right? So that's another thing that you might run into if you're a borrower, that you might have options. And, if you ask me, I can't legally tell you what's the best for you. I would say, hey, go talk to Clint and your attorneys to find out what they would recommend from a tax purpose standpoint, from asset protection. because maybe you can add some color to that, right?
I got it. So a lot of the investors that come to my channel and are investing, they're thinking about, how do I scale? And one of the major dilemmas you're always going to run into is that financing side, right? I always say, if you can use OPM, other people's money, don't use your own, use
Yeah.
bank financing. But the problems, as you know, is that so many lenders underwrite with Freddie Fannie guidelines. Now, where you're different, you fit into more of that, I would say, portfolio lender category is the way I would look at Optimus, is that you provide DSCR loans for sure, but you have different guidelines. And so let's take the example of someone that has two properties and they're looking to buy that third property.
Okay.
If they were to come to you, how would you like them to present it if it's a buy and hold? We'll talk about flipping in a little bit, but if they're just a buy and hold investor, what would they need to do to make sure that they become now fundable with Optimus?
Perfect. Yes. So first and foremost, if you're at the stage of fundable, right? Because the way I kind of look at it, there's kind of 3 to 4 stages: bankable, investable, and bankable being your personal income, traditional underwriting, right? Investable, it's many of the people that you and I deal with on a regular basis, the ones that are out there in educational programs, they're listening, they're learning, but a lot of them, they don't understand how to become fundable yet. They know how to maybe underwrite a couple deals and know how to go after them. But the stage where things get serious, where I like to talk to these people, are the ones that are fundable, right? They position themselves to consistently access capital and close on deals. And that's the key thing. You need to start talking to lenders sooner rather than later, number one. And I would tell you across the board, every one of them is going to tell you, if you're closing in an LLC, get your documents in order now. Don't wait until you put a property under contract, right? And that includes, of course, operating agreement, articles of incorporation. Many of, I'm sure, your clients are registering companies, Wyoming, Nevada, right? States like that. But then they end up doing business in other states, which, guess what? We need a foreign registration. And many of the borrowers that are newer that come to me, they don't even realize that they need a foreign registration. Sometimes that could take days, sometimes they could take a week, it depends. Good standing, letter of good standing, that's a common thing. They don't realize, like, how do I even get it? I'm like, well, go to the website, state website, pull a letter of good standing. Get your ducks in order and put that in a nice folder on your computer. So the moment you lock up a deal, and guess what? The lender is going to say, hey, send me all your entity docs. You go like, here we go. Bam. That alone will honestly save us about a week of going back and forth between the borrower and lender. Common thing that borrowers miss when they send entity docs, a lot of operating agreements will have mentioned exhibits, Exhibit A or Exhibit B, addendums. An underwriter will absolutely point that out. So even if me and my loan coordinator can't pick that up front when we review our entity docs before we send it to underwriter, guaranteed they will. And guess what? That will now become a condition, which will now delay things for another day or two, right? Because now you're scrambling, looking for this exhibit, probably calling Clint and his team, like, where is this exhibit? Well, if you did that up front, it already would have been in your folder. So those are the most common things that delay us as a lender to keep things moving fast.
Got it. And I often tell people that when you're putting together an operating agreement, you have a lender operating agreement that's down, dirty, simple, because underwriting is going to look at it and you don't want to create too much, confusion there. And then
Yep.
after you get your deal done, then you can always amend that and restate your operating agreement to a more expansive, protective one. So, okay, so the LLC makes sense. You got to have all that in place before you go and apply for the loan. But let's talk about the property itself too. So, if I'm an investor and I'm looking at a deal and I want to go, a non-traditional route, I don't want to use the Freddie Fannie conventional mortgage stuff because I want to close in an LLC and I don't want to take title in my personal name.
Yep.
Aren't there some I'm not going to say restrictions, but some aspects to the investment itself that people need to be aware of in order to even qualify for one of the types of loans that you offer?
So, well, good question. So, as I think about it, so really, there's not if you're closing in an LLC, there was never going to be an issue. We will not have really any restrictions there that I've come across, to be honest. Even to the point where, we are so flexible, where certain capital partners will let you add a partner, last minute to your operating agreement and your LLC just so you can qualify for the loan if, let's say, you don't have enough reserves. So we are even as flexible as that, right? With no title, no entity seasoning, right? We call it. So now, when you talk about the actual asset, of course, there could be things that we can run into depending, again, where you're looking. If you're in some rural areas, and then that might eliminate 90% of my capital, right? And then I have to go to my, one that might do that specific state rural area, right? Because now population is low, it's hard to find comps. So that's where we run into challenges. And I would just be very upfront with the borrower and be like, look, you're better off finding somebody really, really local. And to be honest, you're probably not even going to find an institutional funder, most likely, than just go and look for private money. And if they're newer, I would give them some tips on how to do that, right? There's a high chance that those deals are low loan amounts. So I guess that could be another restriction. Most capital partners have minimums, including even our in-house fund. We don't want to go below $100,000 loan because it's a lot of work and there's not much money for those loans, anything below that. So even in that aspect, I would tell the borrower, like, look, you really should consider private money. However, I would say because it's such a low loan amount, here's how I would pitch it. Because again, this is from just my personal experience. I've, flipped a lot of homes in my career, raised a lot of money personally, and you need to make it attractive to the lender, right? The private lender. So in this case, we're talking about that one individual. It could be a friend, it could be a doctor, whatever. If you're going and approaching them for, $70,000 loan, I would say, listen, guarantee them, let's say 12% of 6 months of interest. Because who wants to lend you 50K or 70K for 12% and then you sell it in 2 months? Like, what are they going to make? Like, for that risk, right? So give them a guaranteed 6 months of interest, let's say 12% guaranteed. Even if you sell it in 2 or 3 months, they know they're getting 6 months. Plus, get some nice points. If you have to, do 2, 3 points just to incentivize that early relationship that you're building with private lenders, especially on those low loan amounts. Because I can tell you, you're probably going to get declined with many institutional funds for that specific example. So those would be those, I guess, those main two reasons, I would say. And I'm sure there will be more as I think through it, but those would be the main ones that I can come up with, like rural, low loan amounts. And of course, the borrower, if they have a credit score that's like 550, can we do it? Yes. Again, it will eliminate 90% of our capital, right? Access. We would have to go again to that one that does it without looking at your credit. They'll still run your background. So if you have something hairy on your background, they'll deny you, but at least credit will not be an issue.
Okay. So thinking about then the ideal investor, because I run into people that are experienced investors, they have, 10, 15 properties in their portfolio. And then I meet people all the time that, they're in that situation where they haven't got their first property yet. And maybe their credit is, say, 600, and they're struggling with a local lender to put a deal together. So if they came to you, what would you tell them if they wanted to work with someone like Optimus and get a loan through them? What would that deal need to look like? Should they be doing in order to put that together? Or maybe they can't. Maybe they need to partner with somebody else because they don't have the experience. So I've heard a lot of different factors here on what it takes to get these loans through over the finish line.
Yeah. Well, the good news is that we work with new investors. So that's not an issue. We have access to capital for new investors, not a problem, including people that have very low credit scores. I think the most common mistake I also see when it comes to credit, though, is, when I speak to a borrower, I'm like, great, I ask them, what's your FICO? They're like, oh, it's, 680. I'm like, okay, where are you pulling it from? Like, oh, Credit Karma app. Okay, that's good. I have that too. I was like, however, that's more of that consumer facing FICO, right? Most credit card companies look at that FICO. Lenders, they don't look at that FICO. And that alone is usually like, what? What do you mean? I'm like, you don't want to go down the rabbit hole of FICOs, but just let you know, there is a mortgage FICO. I need that. So then they're like, where do I get it? I'm like, go to my FICO as an example. I tell them, go to myfico.com, sign up for a $30 membership, pay for a month, pull the mortgage FICO for each bureau, send me a screenshot of that because when I end up pulling credit, once you get a deal, most likely I will see the exact same thing, right? Because now their 680 usually is actually now a 660 or a 650. And when someone is on that around that 680 in the Credit Karma, let's call it, I want to make sure I understand what their mortgage FICO is because I can tell you, Clint, the magic number for credit that impacts, I guess, our options of how many options we have is 660. That is kind of the magic number in our space. 660 opens up a lot of options on lending. 620 to 660, it gets smaller. And then anything below 620, it's like very tiny opportunity, right? For lenders. So that's where I would start is let's make sure we understand what are we looking at. Is it the actual FICO? So that's number one. Then the another thing is unfortunately borrowers send me deals and they never send me ARV comps to support it. I ask for it, and then the moment I ask, they send it, and most of the time we're off. And then I ask, where'd you get these numbers? They said a realtor, and they unfortunately lean on their realtor too much for the value, right? And those are not fun conversations because then I kind of like deflate their bubble, right? It's like I thought I had a deal, and then until I reviewed it, and again, I look at it the way I used to look at when I was doing 80 to a 90 flips a year. I mean, I had 3 acquisitions guys. They were sending me deals they would lock up, and my job was to decline as many as possible because I know that the ones I don't decline are darn good deals, right? And they didn't like me from that standpoint because I declined a lot of the deals they put under contract, but it was not that we never lost money, but it was rare when we did lose money, right? And that's the approach I take with the borrowers. I really try to put that hat on of like, can I personally talk myself out of this deal? And I'm going to ask them to give me as much data as they can as far as to support the ARV and explain why. And I can tell you many times when they actually take the time to do it themselves and not lean on their own realtor, they come to that conclusion before they even send them to me. And then they say, Randy, you know what? You're right. I reviewed them myself and I don't agree with my realtor's opinion. I'll let you know if I can get this reduced to a lower number that works. I'm like, perfect. I was like, the best deal, I always tell the people I talk to, the best deal you're going to do is the one I'm going to tell you not to do.
Yeah, I mean, the realtor does have a bit of a conflict of interest there because they want to sell your property, right? So,
That's right. So,
yeah, and then
yes.
you're stuck with it. They move on to their next deal, and you have to deal with this deal that you just got handed.
Yeah.
So, with that in mind, so you talked about flipping. So, obviously, you work with flippers as well on your deals. So, how about experience? Does that play into the lending decision? So for the new investor that's out there that's wanting to get started and they want, like I said, they want to work with a portfolio lender like yourself, is that going to be a problem if they don't have the experience yet?
No, not with us, not a problem. We have plenty of capital for not experience. We put all the office emphasis, of course, on the asset, right? And your credit a little bit,
Mhm.
so we can make sure we could get you in the right product. Now, when you're talking about like DSCR loans, for example, 1 to 4 units experience doesn't really matter. Once you start crossing over the 4 unit and go into the 5+, which is then technically considered commercial, right? Multifamily restrictions come into play a lot more on experience, right? It's a different product. LTVs go down. So like give you an example on like if you bring me a purchase for a 3 unit property and you want to buy it with the DSCR loan, right? You don't want to use your W to income or whatever tax returns. I don't care about those, right? you could buy that property with DCR loan with 15% down if you have decent credit. It could be completely vacant. Completely vacant. We'll go off the projected market rent, right? When we order the appraisal, we're gonna order the appraisal for the value and for market rent projections. And you can literally close on that property as long as it's rentable. Doesn't mean it's brand new. As long as it's rentable, utilities are on, right? I don't care if the bathrooms are pink. People rent, worse
Yeah.
houses. So we can get that loan approved for you. However, the moment you cross over into 5 units plus, right? Let's just stay within, let's say, the 5 to 10 unit, because that's almost like its own little category. Well, now with most capital partners that we go to for DSCR loans, they'll say, hey, maximum vacancy could be 2 out of the 5, 2 out of the 7, or 2 out of the 8. Or they're going to apply a percentage, like, hey, 25% of the total could be vacant, right? So that's when you're going to start running into challenges if you're looking to buy a property with a DCR loan that's completely vacant and you're at 5+ units. Well, that most likely will rule you out from a typical DSCR loan. You might have to go down with like a bridge, right? Because most likely that property needs some repairs. You're going to have to update some stuff. So it'd be more of a value add play. Then you stabilize it, and then we refinance you out into a long-term product, right? With an actual DSCR loan. Good news is we have access to actually capital where there's no seasoning required for your ownership. So you can literally buy that 5 unit with a bridge short-term loan, right? Probably put down 20-25% down, right? Do what you need to do, stabilize it, rent, in this case scenario, let's say 3 out of the 5. Now you can, within 2 months or less, whatever, it doesn't matter. It could be 2 weeks later, you can apply for a actual refinance with a DSCR loan that will be now a 30-year amortization, right? With, let's say, interest rates in 6.5, right? So we can get creative depending on what property you bring. So that's the number one thing. It's like when I speak to people up front, I want to know, what are you going after, right? If they say multifamily, well, okay, there's a lot of different categories within multifamily, because once you step into the 20+ units, the chances of working with me go down dramatically. I can take a crack at it, but I'm going to tell you, go to your local bank. That's agency money, right? Go to your local banks, credit unions, right? Most of those people in those 20, 30, 40 units, they syndicate, they raise money, they add LPs. I mean, that's not what we play with. We don't play in that arena, right? So I need to know, and that's why it's so important. Please, if you're going out there and start submitting offers, talk to someone. I don't care if it's me, talk to a lender so they understand what are your goals, so I can actually give you strategy and for you to be prepared. So when you do lock something up, boom, you're like, Randy, I got this deal. Here is what it is. It's exactly the way you told me. Thank you. We're going to close in 2 weeks, 3 weeks, whatever it is.
If I was going to pull one thing out of this video, and I know we're not done yet with our discussion, is what you just said right there. Because every real estate investor client that has come to me where a deal's blowing up because of financing has been because they did not have the conversation with the lender before they started putting the deal together. And it just befuddles me. I said, well, have you reached out to a lender? You didn't reach out to the lender and tell them how you wanted to take title and how are you going to do this deal? And it's just shocking that no one thinks about that. And I tell investors all the time, you need to establish a relationship with a lender and you need to be conversing with them so you don't get down the road and now the thing starts falling apart on you because they can't do the deal.
Yep. And it's not just one lender, right?
Yeah,
Depending on
true.
your strategies, you
Hmm.
could be like, hey, for flips, I go to here. For DSCR loans, I go here. For multifamily 20+, I go here. I mean, that's what it's going to take if you want to play in this space.
And so people are hearing right now that are watching this is they're hearing from you experience, right? You're giving them information that you just don't get when you go to seminars and things like that, because a lot of times I found that the people you run into at seminars, they're just getting started. They haven't been down this road yet, so they don't understand these things. Which then brings me to the point about when you're applying for the loan, we're talking, you said there's no experience that's necessary to get these loans. But when you get the loan, let's say it's on a multifamily and it's 7 units and you have to have at least 5 units occupied. So I find a building and
Yeah.
it's got right now 5 units occupied, two are under a turn right now. I go in, I get a loan from you with those conditions that are met. Now, does that lender then periodically check on the property to say, hey, are you still maintaining this? Because let's say that I decide to remodel 4 of those units and so they're vacant now for 6 months because I'm
Yeah.
doing an extensive remodel. Would that then get my loan called because they identify that?
No, not in the DSCR space.
Okay.
Yeah, not in the DSCR space. Of course, they will if you stop making payments,
Well, yeah.
right?
Yeah.
The moment you stop making payments, the red flags go up. Eventually, they will probably send somebody there. But uh, in the flipping world, yes, that's common because you usually will either sign up to pull draws, right, to get reimbursed for the rehab you're going to make, or you're going to maybe do a bridge loan, but the lender knows that there is a rehab that to be done. And if they don't hear from you for months and you keep asking for extensions after an extension, they will usually stop you at their second extension request and be like, what's going on? Why you keep asking for extensions, right? And they'll probably send somebody to inspect it. And this is why a lot of institutional money likes to actually lend, especially to newer investors like the total newbies, right? They actually will demand and require that you borrow the rehab money for that very reason that you just brought up, because it creates control,
Hmm.
right? Because then they know, like, well, you have to come for us for draw to get reimbursed. If you don't, uh-oh, that's a red flag. So you'll find that the actual new investors that are getting into flipping, they are actually required to borrow the money for the rehab. DSCR, you're not borrowing money for the rehab. If you did, it wouldn't qualify for that product, right? You're buying an asset that's already rent ready, and if you decide that you don't want to put an emphasis to rent those 2 vacant units, that's on you. Just make sure you make that payment. And keep in mind, they also, we're going to require reserves. So, you're not just going to buy a 7 unit building with zero money in your bank account. Like, we're going to know that you're going to have 6 to 7 months runway liquidity in your bank account for that asset as well. So there is some benchmarks put in place to, I guess, not eliminate risk, but minimize it for that borrower to, start missing payments, I guess.
Okay. So with these loans too, the borrower is going to need to sign a personal guarantee, correct?
I would say 99% of the time, there are very, very few non-recourse lenders. If you go down route, can you find one? Yes. Is it common? No. Just know if you find one, your LTV will be reduced by quite a bit. So instead of, let's say, putting down 15%, uh, in best case scenario, you might be required to put down 30, 35, right?
Yeah.
But in most cases, you are definitely signing a personal guarantee, even though the title is held in this case, let's call it LLC.
Hmm. So when we're talking about LLCs, one of the things that we do a lot with our structuring, for example, let's say I was buying a property in Colorado. I would create a Colorado limited liability company, and that
Mhm.
Colorado LLC is owned by a Wyoming LLC. So for anonymity purposes. So if you looked on the Secretary of State's website in Colorado, pull up the company name, you
Yeah.
wouldn't see my name there. You would see my Wyoming LLC there listed
Yeah.
as the member. And if you looked at Wyoming, you don't see anything because Wyoming doesn't share any information.
Yeah.
So my question is, does that structure create friction when it comes to obtaining loans?
No, we will just ask you for both sets of entity docs,
Hmm.
right? We just want the underwriter needs to, track backwards to you, right? And I mean, we're not sharing those documents with anybody, but, the underwriter keeps it, right? Or whoever capital partner has to make sure that they are lending to the right individual, because once again, you are personally guaranteeing it, right? So that's what we're going to ask. Both sets of entity docs, not a problem. Like we even have examples where, I have a client in Illinois, buys properties to flip. Well, he does the BRRRR method, right? He
Yep.
buys it in a particular LLC that does the renovations, but then he closes on the refi in a different LLC. Not a problem, right? We just want to give us both entity docs, make sure that you are a member, right? And if the member is another LLC, great, we're going to go a layer deeper. Show us those. I don't care. That's it. It's that simple.
So with the DSCR product, they're only looking at that one particular property. They're not looking at your other properties to evaluate your bankability. Is that correct?
That's right.
Yeah.
Yeah, I mean, if it's experience, we will, but not for us saying like, oh, we can't give you this loan because your debt to income is off.
Yeah.
No,
That's not in there. So then, so with a lot of these types of loans and your tax returns, how important are they, if at all?
never. I never look at tax returns.
Good. Yeah, because that's the thing I tell people all the time, becoming bankable, depending on who you go to. If you're going down the conventional route, your tax returns can help you or hurt you get a loan, depending on how aggressive you are with tax deductions, because a lot of times things don't get added back in. So
Yeah,
I ran into that problem too. I was making great money, but I was showing zero taxable income, and it took me out of the conventional market. And that's where I think that you guys come in and you fit really well because people have this, they don't want to pay any tax, but they want to borrow and grow their investment portfolio. And
yeah.
those can sometimes be at odds when it comes to borrowing. Whereas if they're working with your company, they don't have that issue because of the way you structure your deals.
That's right. And I guess one thing I would additionally add is most of DSCR lenders, if you close in an LLC, they will not report those loans to the credit bureaus. So that loan will not even show up on your credit report, right?
Well,
Which is
that's
awesome,
huge.
right? So when you're going to buy a primary home or whatever, using the conventional methods of, Fannie, Freddie loans, they won't even see those loans. So they'll never even ask you about them. Like I just bought a house, primary home, right here in Florida, and I have rentals, right? DSCR loans and LLCs. Like those loans never showed up on my credit report. They were never part of the conversation with the underwriter for the primary home. But if
Yeah.
imagine if they were all, let's say you own 10 rentals and all of them were on your credit report and you're buying a primary home, oh my goodness, that's a nightmare. They're going to ask you for every single statement. They're going to make sure that they're going to want proof that you made payments on time to all those lenders. I mean, the underwriting would be substantial at that point. It would be very annoying to say the
Totally.
least.
Well, that's the whole thing too, is that people don't realize, they talk about the 10 loan limit when you go conventional route and you're trying to juggle all these things around. And many times you're talking about saving, maybe a point and a half on the loan. And is it really worth it because of the effect to your credit profile? I just think it's easier to go a route where you work with lenders who understand the investor mindset and they lend to it, and you get this simplicity and ease of obtaining financing, and it's expedited. So
Yeah,
this,
well,
what's
I would
that?
say though, man, it's so crazy though right now, and this won't be forever, I'm sure, but right now I can get you a DSCR rate that's on par with conventional. So meaning like if you were to go and buy a rental property, using conventional financing, you might get quoted in the high sixes also, and I'll quote you in the high sixes for a DSCR loan. And my brother-in-law actually just texted me yesterday because he bought one conventionally. He's got a great job. Both of them are
Mhm.
engineers, so he just went the conventional route. Great. He's texting me yesterday. He's like, "Hey, I'm thinking about buying another property, and my lender's telling me I have to put down 25% again because that's what he was told on the first one." And he's like, "Can you do it for less?" I'm like, "Yeah, 15." Like, like I can beat his own conventional lender on the down payment and probably match the rate.
It's
Like
amazing.
that's not normal. That's I mean
Yeah.
I don't know if this will last and for how long, but right now it's amazing. This is why DSCR loans are blowing up because they're at par, if not better, in many ways to some of the topics and reasons we're discussing. to a conventional.
Yeah, because I know 2 years ago it wasn't that way,
Nope.
but
Yeah.
things have changed. All right, so how about if somebody came, you said you can't do land trusts. How about a series limited liability company? Because I have a lot of people that invest in Texas, Oklahoma, places that recognize that structure. Does that work
Yeah.
for you?
Yeah, yeah, that shouldn't be a problem. So,
Okay.
yeah, as long as it's not like I said, trust and things of that nature. Uh, Anything entity related, we can find a way to make it work as long as again we can track back to you as one of the members, right?
Yeah. Okay, so creative financing. I mean,
Yeah.
you're at the same events I'm at, and you run into people all the
Yeah.
time. They're doing subject to or owner carry deals. Do you ever fit into that some way, somehow for those investors?
Yeah, so I guess the only thing we can talk about is second loans, which we can do.
Hmm.
Um, so that might be a way for us to talk. So let's say you buy a property, not subject to it, but seller financed,
Yeah.
right? So you own it on title. The seller is the bank, right? But the loan is not in the seller's name, right? Like a subject to would be.
Hmm.
So in that scenario, I mean, you have a first lien. Let's say the property's worth 500 and you did seller financing for 300 of it when you bought it a couple years ago. Well, now you have $200,000 in equity. Well, then we can talk if you would like to keep that seller financing in place because you got an incredible rate at 3.5% with the seller, right? And you want to leave it in place. I get it. We can still talk for that equity piece. And then, of course, we'll be maxed LTV, right? Usually up to 75% between the two loans, right?
Got it.
So that's where we can come in. So it's a second DSCR type of a loan behind your first.
Okay, so you kind of went past the subject to, but I'm wondering this. So let's say somebody ties up a property subject to,
Yeah,
deeds now in their LLC, so they're on title.
yeah.
They come to you and they say, "Listen, I want to take out the first. I want to refi this property." Assuming there's plenty of, 20% equity there, could you do a deal like that?
Oh, yeah. As long as we're paying off that lien and
Hmm.
it's getting wiped out and we're coming in first lien position, yeah, that's not an issue.
Okay, yeah. So that's excellent. Because sometimes people get, I've seen this before. I've heard from investors that the lenders that they've worked with, they get very uncomfortable when they see that the owner on title is not the borrower that the loan was written under. And it just, they don't understand it and it creates
Yeah, yeah.
problems, friction there.
Yep.
Yeah.
Yeah, I think the biggest thing is there is as long as that lien gets paid off at closing. That's the biggest thing. So,
So let's say I got an investor and they want to put their foot on the accelerator and their deal is I want to put 12 properties, get 12 properties a year for the next 3 years. Is there anything that ever somebody's going to run up against with these types of loan products if they're going out there, let's say they're buying single families and they're really aggressive at it and finding them? Is it a matter of, hey, it's on a deal by deal basis and that's all you guys look at?
that's it.
That's
Yeah.
it.
There's no limit on how many. That's right.
So you can scale
So
quickly.
go at it, man. Knock
Yeah.
yourself out.
So one other thing, though, I'm going to go back to this. I just thought of something. When you mentioned land trust, so how about if it's in a living trust, something that looks, a grantor trust? Is that a problem? Or
No,
so?
that would be okay. I have a few that would be okay with that.
Okay.
Yeah.
Now, what would you say? Let's say we create a trust, and you're my client.
Okay.
And you asked me to create a trust. I create a trust. And you say, Clint, I don't want my name to be on the trust as the trustee because when I take title, I don't want to be shown up there. I want some anonymity. So I want you to be the trustee. So I'm appointed as the trustee of your trust. You're listed as the
Mm,
beneficiary of the trust. And then if you pass away, it goes to your kids.
got it.
Would that cause a problem?
That one I would have to run up the chain to the underwriter.
Okay.
Uh, I haven't come across that specific scenario. So yeah, I would have to.
Well, off the top of your head, what do you think might be the friction on that one?
Well, I guess you know,
Who the hell's Clint Coons?
what's that?
Who the hell is Clint Coons? Why is he on the as a
Yeah, is
trustee?
Clint gonna also personally guarantee the loan, or I don't, I don't know what questions an underwriter will add additionally to it. I'm sure there will be plenty.
Yeah.
But yeah, it's hard for me to speak exactly what that could be in that
Okay.
case, because it is more creative, of course, and I get it. But the more creative you get, the more, underwriters are going to pick it apart. That's just the reality. Not to say that you shouldn't do what, your firm, let's say, suggests. However, again, I think that's just another reason why you should speak to lenders sooner rather than later, or at the same time as you're creating your company structure, right, with someone like you, because that's very common, I'm sure, right? People are not thinking about the lender when they're talking to you so much, right? And they might change their whole strategy if they were speaking to a lender and you at the same time, because they'd be like, oh, Clint, I love what you're saying. However, it will limit me to do X. Great. Well, then let's do this, you will tell them, right? In the meantime. So I think we need to work hand in hand in this situation with a company like you and the lender. So you can really, I guess, eliminate friction as you go and expand and dive into real estate, right? Because the last thing you want to do is, I guess it's not a bad thing for you guys, but call Clinton back and his team like, hey, that land trust we created, we have to undo it, right? We have to put it back in the LLC. And it's like, okay, well, you don't care, you'll do it. But that's just, you're going to lose weeks of time and money where we could have addressed that right from the beginning when they were forming all of their company structure and everything, you know?
Yeah, that would be an optimal situation if Optimus would say, all right, here's the structures that I like to put together. It's a trust with a Wyoming LLC there. It's still a grantor trust. Client owns both. Yeah, we bless this. We bless this one. That one's a no-go. And then I just think it how easy it'd be for our investor clients to say, all right, well, this fits box A, and I know what the underwriter is going to like box A, and I can do the deal that way, but I can't do it in box B because there's problems there.
Yeah, and I mean, I think that would be an incredible kind of guide, right? So feel free, send me your scenarios, Clint, and I can go to my underwriters and see, which one would allow which box, right? Because that just because one says no to box A doesn't mean the other one won't approve it, right? And that's the beauty of this, that, we have access to, some of the most creative money out there, and they want to do business. They're not in the business of not lending, but some are, stricter guidelines than others. So that would be awesome to put that together.
Yeah, I think we could do a lot there. Should have thought of that before. Anyways, hey, is there anything else you want to share with people about your podcast, Optimus, that I didn't cover you think is important?
I guess, I mean, one thing just to bring up again as just like a tip or a reminder, like, I know your audience, a lot of them are newer. Just because you don't have money, like, don't let that stop you, right? From pursuing real estate. One, on the flipping side, not an issue, right? You'll find institutional money like myself and others that can do that. But even on the rental side, right? If you're good in finding rental opportunities, but maybe you don't have the capital, the liquidity on the reserves and et cetera, go find somebody in the network, right? That has the liquidity, and make them a partner of the LLC, because most likely Clint is going to tell you, yeah, buy this five family in its own LLC because it can have its own challenges, right? You
Mm-hmm.
probably don't want to have multiple multifamilies in one LLC. Well, then that would be perfect. You bring in a partner that has the liquidity, and now we use their liquidity as it's yours because it's now part of one LLC. So bottom line, what I'm saying is get creative, right? Even when you don't have the funds, that should not be the reason to not get into the business, regardless if it's flipping, buying rentals. You will find the right partner as long as if you are good at finding opportunities, man, people are out there, man, willing and able and wanting to partner with you. So that would be my biggest kind of tip for everybody out there, and for myself, you can find me. I have a very unique name. I think I'm pretty much the only one in the world named Randy Zimnoch. So that makes it very easy. That will kind of take you to my world, everything that I do on the funding side, real estate side, etc. So that would be the easiest. And I'm here to help you. And the way I like to say it, as I'm doing more and more on the lending side, is I'm your coach first, lender second.
Yeah, awesome. Hey, thanks for this. I really appreciate it. I hope people are going to get a ton of value out of this. I mean, just from our conversation, a lot of things were going through my mind about putting deals together. And what I'm going to do, as I stated, I'm going to put links in the show notes to Optimus, to your podcast, how to get a hold of you as well. And guys, take advantage of it. I mean, as he stated, right now, the rates are the same as conventional, but you're going to be able to put deals together a lot easier with someone like Randy and Optimus than you are going the conventional route. I mean, anybody that has gone through that route before knows that to be the case.
Yeah.
So again, Randy, thanks for coming on. I really appreciate you taking the time. I know you're a busy guy and you got a lot of deals to work on. So I appreciate it and I wish you the very best.
Yeah. Thanks, Clint. Thanks for having me on.